Hello and welcome to Lesson 5. Financing is our topic today for lesson number 5. My name is Jack Gately. I'm the owner of Jack Gately Real Estate and the real estate school that you're attending. So thank you very much for joining us. We've talked in some prior lessons, if you're taking them in chronological order, about valuation. Now let's talk about how these properties are actually purchased for the most part. Of course, you don't need financing if you're going to pay in cash, and some people actually do buy real estate in cash. Now, not actually, they don't show up with a suitcase of money or anything like that, but they usually show up with a certified funds, and that's how they pay. But for the most folks get a mortgage or receive a mortgage, or actually the better phrase to use, in fact, technically, is they give a mortgage to the bank, and a mortgage is just basically a promise. So before the bank agrees to accept that promise, they have to look at the deal, both the borrower and the asset, and make a decision of whether or not this is a good risk for them to take on. So when we look at that, we call that financing. And so let's go take a look at one of the number one risk factors that a lender is going to take when they make a decision whether or not they're going to lend on the deal, or what rates they may charge, is called the loan to value ratio. Loan to value ratio. I hear you people that don't like math. You just groaned. I can hear that. Remember, just as a rough estimate, about 10% of the exam is math, roughly. And technically, you could get every math question wrong and still pass the test, but I do not recommend that. And I really think you should kind of work on these math concepts, both for the exam, but also for real life. People are going to expect you to be doing some basic math for them. So let's take a look at the loan to value ratio. Now, the loan to value ratio, from a technical point of view, works like this. It's the amount that the bank will lend as a ratio to what it's worth. First off, the appraised value. So the appraised value and or the price that they're willing to buy it for. And they're always going to be looking at the lower of these two items, So keep that in mind. So what they're willing to lend versus the appraised or price, whichever is the lowest of those two. So in most cases, it's funny how these things work out. The appraisal usually comes in equal or darn close to it, maybe just a teeny bit over the actual price that the buyer is paying. So let's just set aside this matter for the time being, and let's call value, when we are talking LTV, as price. So basically, it's the amount that they're lending versus the price. So in this case here, banks look at this whole situation as something that they want to see, for the most part, 20% down. And so let's just make this really round numbers, very, very easy. If the price of the property is $100,000 and they're looking for an 80% loan to value ratio, then they'll lend this much on a price of this much. That one's so easy. So loan is going to be 80. They'll loan 80 for a value of 100,000. As a general rule of thumb, as soon as we hit 20% or go above it, the bank is going to be more confident that you have more money in the deal. And so whenever we see an 80% loan to value ratio, that's really the maximum that they feel comfortable with. They'd much rather see this number go down. And so on this deal here, if you wanted to buy a $100,000 house and you are asking for them to lend you, say, $90,000 on that deal there, your loan to value would be 90%. They would feel very uncomfortable about that. If they're very uncomfortable about a 90% loan to value ratio, basically they're saying, the buyer is only putting down 10%, and therefore maybe the buyer doesn't have as much skin in the game, and consequently we need to really look at this deal. And they may charge you more for this type of mortgage, and they might ask you to put down some points, for instance. They might charge you a higher interest rate, or they might charge you what we call PMI. So what are these extra fees that you can pay along with getting your loan, aside from the basic interest that you're already aware of? Well, there's points, and sometimes in a higher interest rate environment that we are today, I certainly remember when interest rates were more like 6, 7, 8, 9%. Oftentimes, if you applied for your mortgage, borrower lender would say something like that. They'll give you a choice. Here, Jack, you can get a loan for 5% with 2 points, or you can get a loan for 7.7%, Jack, with 0 points. And it's up to you, Jack, what you want to do. Just let us know. Funny thing is they always win either way, right? I'm going to say yes to one of these two, and they've made a loan, hopefully, for them. Or I can continue to shop, of course, as a consumer. I'm not obliged to borrow if I don't want to. But in these two situations, these are fairly common things where the points, this here, the points is 1% of the loan. Don't get mistaken by making 1% of the price. It is not 1% of price. It is not 1% of price. A lot of people get the test question wrong because they figure out the points based upon the sales price. It's always based upon the loan amount. Very, very important distinction there. And so in this particular case here, if I was going to be buying a $100,000 house, just to make it easy, 2 points would cost me $2,000. All right, so it's money that you're putting up front, basically kind of like a prepaid interest. So either way, the bank is going to get their money, of course, but this is a way where they can get a little bit of it up front and charge you less money over time. Now, of course, on the table where this is all spelled out, there's a point where one loan is better than the other. Clearly, if you're going to fix up the property and sell it soon, then it's better to have money in your pocket and go with this option. If you're going to buy and hold, then it's better to go with this option, because over the 20 or 30 years life of the mortgage, the 5% deal is much, much better if you're going to buy and keep this mortgage for a long time. Much better deal. So that's what points are. Now, origination fees, I think you probably already know what those are. They're fees for the credit reports, appraisals. They might have some other names for this stuff, but it's money that you have to pay out of your pocket in order to get the deal done. Private mortgage insurance, that is a tricky one. A lot of people get that a little bit confused. Sometimes when your loan to value ratio is higher than you want it to be, like over 80%, especially when they get a little nervous, very often the lender will require you to take out an insurance policy called private mortgage insurance, which is going to insure the lender. It's very interesting. The lender is the beneficiary, but the borrower pays for the premium. So it's almost like taking out an insurance policy against yourself, but you can't get the loan if you're over LTV of 80%. Unless you usually can take out private mortgage insurance. Now, this does vary with various market conditions. I remember a time of irrational exuberance in pre-2008 where I bought a house with less than 20% down, and I never paid private mortgage insurance, but that's just how things were then. So, but nowadays, since 2008, you most certainly are going to be paying PMI if you have a LTV, which is higher than 80%. So those are very important concepts. of how you should be thinking about points. They're always 1% of the loan. Don't get that one wrong on the exam. They're always 1% of the loan. Then there's some other fees that you might have to pay. And then you might have to pay, if your LTV is too high, this private mortgage insurance, because the lender is nervous that you don't have enough equity in the deal. So let's just take a quick step back, however, and just look at the loan process. Of course, you have to apply, and in most offers for residential real estate, at least, there's going to be a deadline that in order to comply with the mortgage contingency that most people put in most of their offers, there's going to be a deadline in the offer by which you need to apply. I usually put that out 7 days from the date of acceptance of the offer. So I want them to put the offer in, get it accepted, and then, and then give my client another 5, 6, 7 days to actually apply, just to let you know where I usually stick that in. And then, of course, they're going to process that loan, and they're going to be asking for all sorts of information, looking at the credit worthiness of the applicant. They're going to be giving you the how should we say this, financial colonoscopy inside and out. They're going to be looking at your sources of income. They're going to be looking at your assets that you have to put towards this deal. They're going to be looking at your liabilities. Everyone has them, right? Of course, some bigger than others. Of course, they're going to be looking at your credit score. Of course, nowadays you can go on the internet and get a free credit score, but most lenders aren't going to accept the free credit score. They're going to be looking for your official FICO score, By the way, if you probably heard that phrase, FICO, it stands for Fair Isaac Corporation, just to let you know. That probably won't be on the exam, but it's probably a good little buzzword for you to know. Basically, they're going to be asking, can you pay the loan back? Can you pay the loan back? They're asking really two questions. Not only can you pay the loan back through the loan application process, but once they've finished with the loan application process, looking at the borrower, then they're going to be looking at the collateral that you're putting up. In other words, the price, the house that you're buying. Because if you might be able to pay the loan back, but for whatever reason you lose your job or whatever, something bad happens and you can't make your monthly payment, they're going to say, well, now we need to sell the house in order to satisfy the loan, and therefore they're going to foreclose because you can't pay the loan back anymore, and therefore they need to look at two things. They need to look at you, the borrower, and B, the collateral that you're putting up in place of your, heaven forbid, you can't pay the loan back. So 1 and then 2, that's what they're looking at. So what type of loans are we talking about? Well, we have basically 3 different types of loans that we need to learn for the exam. There are a lot of other different types of loans to learn, but you're not taking mortgage class. Remember, you're taking real estate class. So you do need to know the difference between these 3 types of loans. And the first one is the term or the straight loan. And in this particular case, basically you're paying interest on a monthly basis, and then at the end of the loan term, whatever that happens to be, then you have to pay off the principal. So this is how that loan works. You're not actually working to pay off the principal during the course of the loan. You have to pay that off at the end in one payment, one lump sum payment. So for real estate, we usually don't use those because no one wants to borrow $300,000 for their house and paying interest on that, and then at the end of the loan come up with one $300,000 payment. So that's not really practical, but it is a thing that you should be aware of. A term term or straight loan. Again, your monthly payments consist of interest only, and then at the end of the term, wherever it happens to be, you have to come up with one big giant payment to pay off the actual amount borrowed. Nope. What we usually use in real estate is the installment loan that has a level payment. So if your mortgage is $1,000, we'll just write that here. If your mortgage is $1,000 for the first month of the loan, it's also $1,000 for the last month of the loan, all things being equal, assuming that, of course, your real estate taxes are never go up and anything. And remember, many times people have their real estate taxes included in their mortgage payment, but for the purpose of this discussion, we're not including real estate taxes in this $1,000 that we have here. So in a normal installment loan, and I'm going to kind of come up with an exaggeration here, but on month number 1, you're probably going to be paying $1 towards your principal and probably $999 in interest. Is rather disappointing. And then as the time goes on, if we're going to keep this for 30 years, on month number, that would be 360, right? On month number 360, theoretically, of course, these numbers, you'd be paying $999 in principal and only $1 in interest. And somewhere in the middle, during the middle of the loan somewhere, this ratio between what you're paying in principal versus what you're paying in interest on any particular month flips. And that's that table that describes this is called, this is a very important term that you should know, the amortization table. It's a tough one to pronounce. Let me spell it out here for you. Amortized loan. There we go. Get the Z in there with a little hash mark. I like that. All right. So and it comes with a table that you can read and find out how long it's actually going to take until you actually start paying off more in principal than you are in interest. My father always told me, he says, John, son, when you go and buy the house, don't look at the table. Don't look at the table because you're probably not going to want to buy the house if you actually look at it. It's rather pessimistic. You're like, ooh, wow, don't look at this because you don't want to necessarily look. You might talk yourself out of buying the house. And he says, don't look at the paperwork. Just go to the closing and sign. And actually, that's what I did. Took Dad's advice. And we still have the house, so fortunately somehow we figured out a way to make it work. All right, so that's enough of Dad's financial advice for this lesson, at least for the moment. So that's what most people use when they buy a house. They buy it with a basic installment loan where the monthly payment stays the same, theoretically, for the term of the loan, and not including your real estate taxes and that type of thing. And it flips during the course of the period where in the beginning you're paying hardly anything towards the balance, the primary outstanding principal balance, and you're paying everything in interest. So the bank, the lender, if you haven't figured this out already, they get their interest up front and you get your ownership share on the back end. See how that works? Yeah, they're not that, these lenders, they're clever folks. They figured this out. So there's also this other thing called an ARM. Oh God, what? Of course there's a thing called an ARM, Jack. What are you talking about? No, this is called an adjustable rate mortgage. Adjustable rate. And there's all sorts of different adjustable rate products that are out there in the marketplace. We don't have to go too far into them other than to let you know that in some interest rate environments, and it appears now, by the way, as I'm speaking to you in late December 2016, that we are going to be moving into a period of somewhat unstable or harder to predict interest rate environment. And so You might know that the Federal Reserve just increased interest rates last week, and they also indicated that they might be increasing interest rates as many times as 3 times in 2017. So you might see the ARM product come back, and it has a lot of different varieties to it, but just something that you should be aware of. It's not necessarily that popular in the marketplace now, but it always comes a place for it. So I just want to drive home one other point about that the level payment loan is that clearly at the end of the loan term, we'll just call that 30 years for now, it's going to be fully amortized. In other words, you paid it off. You paid it off. With a level payment loan. So a level payment loan, just going to write that down here again to drive home this point for you. Level payment loan is fully amortized. There is this other product, however, that would be called a partial amortized loan, in which case you're making payments. We'll just circle these as what would be theoretically affordable payments for your average buyer. And these are partial interest and some principal. And how a partially amortized loan works is that you get this loan usually in a very high interest rate environment where you couldn't otherwise afford to make a normal payment. And then at the end of the term, you got this giant payment that's due. And if you kind of draw it like this, you have a balloon payment due. And nobody likes a balloon payment. That means you have a boatload of interest due at the end of the year. This is kind of like a hybrid, if it sounds like it to you, between a level payment loan and a type of straight loan. It's kind of like the mix between the two. And of course, sometimes when you have a balloon, what happens? It's going to pop, and the air comes out of it, and you can't afford to make the level payment loan. So if you got this type of loan back in, say, 1981-ish, and you said to your spouse, this is the only way we can get into the house. Let's get into the house. We're going to get a balloon mortgage. This will help us get into the house, and the values will go up over time. And if that was your bet, you were right. In starting in about 84-ish, the economy started to pick up as there was a new administration in the early 1980s, and by the 84, things started to rock. And if you sold or refinanced in 84, 85, or 86, you made the right move, because then in 1987, things went bad in October of 1987. For those of us who are old enough to remember, I was just a young lad. But of course, values went down, and now you couldn't sell, and maybe your balloon mortgage was coming soon. And this happened a lot down the Cape in 88, 89, and 90. There was a huge problem with people having to pay off these balloon mortgages, and Cape Cod got hit disproportionately than some other areas in the country. A lot of people had balloon mortgages down there, and basically it's a hybrid between a level payment loan and a straight or term loan that we spoke about earlier, the balloon mortgage. You know, while we're at it, why don't we talk about a couple of other loans that you should be aware of? This one here is a kind of funny name to it, but it's called purchase money loan. Purchase money loan. Basically, this is just a fancy name for the seller also is the lender. The seller is the lender. So in this particular case, the seller sells the asset, and the buyer gets a loan, and they just get a loan from the seller. So every month they send in their monthly payment, just like they would to the lender, although in this particular case, the lender is also the seller. So basically the seller is playing both roles. And you, from time to time, you would see that type of transaction. Relatively unusual, but it does exist. The next option here is package mortgage. And this is when you buy both personal property. Ooh, we don't usually mortgage personal property, do we? Oh, no, we don't. But we do it when we get a package mortgage and real estate. We package it together. Get the definition there, okay? And this would be something when you buy something like a store, lock, stock and barrel. That would be kind of a lock and stock. Gonna buy the store and buy the stuff in the store. Or a farm. If you bought the farm, you might also buy the farm animals. So there's ways to think about the package mortgage option. The blanket mortgage is a little bit interesting in that this is something that is going to include what we call the partial release clause. Partial release clause. And I hope I have enough space here to write that out. Yes, I do. I'm going to use this space down here to kind of give you an example of what a blanket mortgage would be. So let's just say, for instance, you bought more than one property with the exact same loan. That would be a way to think about it. Also might be a way to think about it if you bought one big property and maybe you wanted to subdivide it like this. And maybe you wanted to build a house on this one. When you sold the first out of 6 houses, you would pay off the loan that day, and this is a dotted line, I hope you can see that. And the partial release clause would allow you to pay off the loan representing this amount here, and therefore allow you to transfer title to the person who bought that house. So that's a nice way to think about the partial release clause that goes with a blanket mortgage. It covers multiple parcels, multiple parcels. You might even see it called that, the multiple parcel loan. Oftentimes developers, sometimes though you could see it with a residential application where somebody might have a loan on their primary residence, in Norwood or something like that, and then a secondary beach house like in West Dennis or someplace like that. So you do see it in those examples. And then it leads us to the last one, which is called the reversed mortgage. The reverse mortgage. Now, the reverse mortgage is basically, the best way to think about this is basically selling the asset, which is the real estate, back to an investor effectively every month. You're selling your house off month by month. So it's a slow process. You must be 62 years of age to qualify for a reverse mortgage. So you've probably seen these ads if you've ever seen some type of afternoon television. In the afternoon, you're going to see a picture of this guy. That's right, Tom Selleck, because he's the one that comes on in the afternoon amongst other actors like the Fonz. And look at that, we're moving Tom Selleck around. We don't want to do that. Afterwards, the Tom Selleck comes around and the Fonz comes around. Before that, it was Senator Thompson. So usually some type of older actor comes along and tries to assure you that a reverse mortgage is a good idea. In many cases, it can be a good idea. You have to be age 62 or more, and basically you're selling your house back to the mortgage company month by month, and you can continue to live there, and basically the mortgage company is making a deal or a bargain or a trade-off, and they're trying to figure out if it's a good deal for them, because even if you've sold the whole house back to the mortgage company, you still get to live there after that point. And so that's why you can't do it unless you're at least 62 years of age. And it's a bargain, or it's a deal that they're making. They're predicting that it's going to work out for them. Back in the 90s, maybe even more recently than that, there's a lot of scandal relative to the reverse mortgage product. And nowadays, that's why we have people like Tom Selleck that do these ads that are supposed to put you at ease as to whether or not it's a good financial decision for you. It can be a good financial decision for you if you are what we call house rich. Means you got a lot of equity built up in this house because you've had it for a long time. It's basically your piggy bank, but cash poor. So you're not making a lot of money on a like, for instance, a monthly basis. Your monthly income is limited. So you might go and say, hey, does someone want to buy my house but incrementally? So that could be a good deal for some people, and that's what a reverse mortgage is. And since we mentioned reverse mortgage, we kind of also touched briefly upon the concept of equity. Equity basically means that if you bought your house, well, I should probably rephrase that. Equity typically means that if the value of the house is, say, $500,000 and you only owe $50,000, this would be a situation where you certainly would be house rich by the tune of $450,000. The problem is that's on paper, right? And you can't bring your balance statement to the grocery store and pay for your groceries. And so this is why some people who are over 62 take advantage of the home reverse mortgage product. And it also might be why some people try to get a home equity mortgage. That would be, in other words, closing this gap here so that your value stays the same, but now you have two mortgages. The one that you had for 50, and maybe you take out another one for 100,000, for instance. And so now you're going to have only the $350,000 in equity left. Still pretty good, but that's lower than 450. But now you got an equity loan, which means that you got a lump sum payment of $100,000. So there's an equity loan, and then there's an equity what we call an equity line of credit. Line of credit, sometimes abbreviated as home equity line of credit, HELOC. So there's two different products there. I just want to drive home this point. There's the equity loan itself, and then there's the equity line of credit. With the loan, they actually give you a big hunk of money. They give you the $100,000. With the line of credit, they actually just give you a checkbook, which is basically equal to $100,000. It means you could write $100,000 in checks out of it if you chose to. So, something to think about, slight difference between one and the other. Pretty much they, for the most part, home equity line of credit is a good thing to have if you have a ton of equity in your property, in case, of course, you have a rainy day come along, so to speak, and you need to pay for some stuff. So not a bad thing to have, is kind of in your back pocket as a insurance policy in case something bad happens with your financial situation. But you don't want to go out and buy a Cadillac with it, or go to Vegas with it, with your home equity line of credit. And that's unfortunately what people were doing in pre-2008, is that every Friday afternoon you'd come home from work, and you made whatever money you made coming at work, and your house would be worth another $500 or $700 or $1,000 more than it was the prior Friday. And so eventually you start looking at your house as a giant ATM. And you get a home equity line of credit, and then you go and do something that would be not necessarily financially a good move, and then you're headed down to the August of 2008 situation, so where values declined because basically we used our real estate as inflated values. We took it out, we invested it in stuff like depreciating capital assets or entertainment, and therefore we lost value. So getting sidetracked there for a quick second, we're going to head in and talk about the secondary mortgage market in a few minutes, and that's kind of what we're leading up to here. But I want to let you know that should you have a lot of equity in your house, because of a clause in the mortgage, which we're going to go over in a minute, you can actually get an additional mortgage, like a secondary mortgage or an equity line of credit, or an equity loan itself, where they actually give you the whole amount. So that's a very important thing. I think that for the most part, because our values are not necessarily skyrocketing through the roof like they were pre-2008. The activity in the home equity line of credit market is less than it was, say, 2005. Everyone was getting, and I do mean everyone, obviously oversimplification, but lots of people getting home equity line of credit in 2004, 2005. It was all the rage because you were coming home every Friday afternoon, and your house was worth more money. Your house was worth more money just sitting there. It was a beautiful thing, but yes, as they say, all good things come to an end. Let's take a quick step back. In fact, since we've talked about a number of different types of mortgages, let's take a quick step back and just refresh or reinforce the concept that the borrower is the mortgagor. The mortgagor. Remember that English language lesson if we had it earlier? I'll remind you here. And the lender is the mortgagee. That's because you, the buyer, for instance, this is you. If you're buying something, you're actually giving the mortgage to the bank. And the mortgage is basically a promise. That's all it is. It's a promise. There's this phrase, hey, we got a mortgage to buy the property. No, actually you didn't. You got approved to give a mortgage. Basically, the bank said, we will accept your promise. And therefore, you, the borrower, are the mortgagor, and the lender is the mortgagee. Remember, of course, that the mortgagor, anybody with the OR at the end of their name, is always the person giving, and the person with the EE at the end of their name is always the person receiving. So, very important point here, just to drive that home. Very, very easy to get that confused. So if this is the case where the buyer is giving a promise, then we're going to have what's called a promissory note. And a promissory note is basically an IOU, although they don't draw it on the back of a napkin, and there's some very important clauses that you're going to need to know what's in this promissory note. The promissory note is the primary evidence of debt. Ooh, that sounds like an important vocabulary word, doesn't it? Evidence of debt. Oh, let's write that over again. I kind of stepped on my little finger there and kind of make it blurry there. Let's start again. The promissory note, sorry about that, folks, is the evidence of debt. Primary evidence of debt. So, there we go again. Look at kind of getting a little flurry there with my pen. Debt. There we go. So the promissory note is the IOU, or officially the promissory note is the primary evidence of debt. Okay, so in that case, what's in this note is very, very, very important. Let's take a look at the clauses that make up the note itself. Okay, so what are these important clauses in the note? Well, the first one is going to be the acceleration clause. And this is going to be the one that benefits the lender. Going to benefit the lender in this particular case because, heaven forbid, you can't make your monthly payment and you miss too many monthly payments and you're behind. Eventually, they're going to foreclose. So the acceleration clause in the note itself is basically saying, I owe you, and if I don't pay you in these monthly payments as I should, as I am agreeing to, then if I get too far behind, yes, you can take the asset and you can foreclose. Why do they call it the acceleration clause? Because the loan has a maturity date, a date that it needs to close, and for most loans now it's 30 years in the future. But should they close or call the loan due, they're going to call it sooner, and therefore they have accelerated it. And they accelerated it because you didn't pay your monthly mortgage payment and you missed too many, however many it happens to be. And that's what the acceleration clause is. So defeasance is basically the opposite of that. And while the acceleration clause benefits the lender, the defeasance clause is going to benefit the borrower. So they're kind of the opposite. And basically it says if you pay off the debt, then the lender's claim to your property will be released. So the claim is released should you pay or satisfy the amount due. Basically, you are defeating the mortgage that you gave. There, hence the definition there. You can see it almost right in there. So you're defeating it by paying it off earlier than the 30 years. Now that obviously begs the question, hey, do I pay it off early? Do I get penalized in some way? Well, not here in Massachusetts. And we have in Massachusetts, excuse me, I misspoke. We have pretty much everywhere nowadays a due on sale clause, which basically means that on the day of closing, when you transfer the property, you have to pay off the old lender. Keep in mind, when you go to a closing, there's going to be the lender that represents the attorney that represents the new lender. There's going to be the buyer and the seller and their agents. The person that's not there, or the entity that's not represented, is the old lender of the seller. And they're not actually at the closing, but let me assure you they are there in spirit, and they're going to be making sure that they get paid off at closing. So it's not possible in most loans nowadays to actually sell the asset and still owe the money. That's not how things work nowadays. Many, many years ago, that was a thing, that you could actually sell the asset but still owe the money, but nowadays you can't because of the due on sale clause, that the note and the money relative to the note are going to be due when you sell it. So that's why the lender that closes the loan has to go find out, and you may be part of informing your clients about this, they have to go find out how much is due on the current mortgage down to the last penny, and it actually varies on a day-to-day basis. That's called the payoff amount, the payoff. What's the payoff? In other words, they gotta pay that off as part of the proceeds, and hopefully there's more proceeds than there is to be paid off. All right, the next important clause in a note is going to be the subordination clause, and this basically allows you, the borrower, to get an additional financing. Basically, it allows you to do those types of things we just spoke about a few minutes ago, like the home equity line of credit, or you can get a second mortgage, and usually no one's going to give you a second mortgage on it and sit in a secondary position to get paid off unless there's equity in the property. So that's how that works. And the last one, of course, is the estoppel clause. And wow, we could go down a real long rabbit's hole, far down an alley to talk about the estoppel clause. But basically, the estoppel clause prohibits you, the borrower, from disputing the terms of the loan should the loan be sold to a different servicer or a different lender. Say what? Huh? Well, occasionally you might get a letter in the mail. It's probably happened to you or somebody on the webinar, certainly, where you get a loan in the mail saying, let's just call it a car loan. You know, you've been doing business at Acme Bank for a long time, paying off your car loan, your local credit bureau, whatever, and they send you a letter in the mail that says, "Dear valued customer, as of the first of the month, don't send your payment to Acme anymore because we've sold your account to Mega Bank. And when we sell your account to Mega Bank, you have to send your payment into Mega Bank, and they're going to give you the phone number and the address and everything else like that. Your loan stays the same, and you may be happy about this, or you may be less than happy about it. Doesn't really matter because there's nothing you can do about it. Keep in mind that your loan from a bank's point of view is an asset, even though you kind of think of it as a drag that you have to pay it every month. But your loan from the bank's point of view is an asset, and occasionally banks trade assets. And this estoppel clause prevents you from disputing that trade or the terms of the loan. So very important one to understand for the exam and for real life. And that's why they can sell your loan. It's probably happened to you before, or certainly something that's happened to somebody you know. So again, the acceleration clause benefits the lender. Heaven forbid that you don't make your payments. They can call the loan due in advance of its normal maturity rate, a date, and foreclose to collect their asset, to make them whole, hopefully for their point of view. That you can defeat the mortgage through the defeasance clause. You have to pay off your mortgage amount at the day of closing. You can add more debt to the property, especially if your equity goes up. And sometimes your loan is sold under the estoppel clause from one lender to another. So who actually owns the property if there's a mortgage against the property, if you've promised it to somebody else, right? Think about that for a second. You live there, but you've promised the house to somebody else, the lender, if you don't pay. So who really owns it? That's a tricky legal question. And there's basically two theories that address this. There's a third thing that we'll also talk about this in a second. I couldn't actually fit it on this one page. But who owns the property is answered by these two essential questions. And we're going to get to deeds of trust in a second. But effectively, we have title theory and this is on a state-by-state basis, I should add. On a state-by-state basis, we have title theory. So some states are title theory and some states are lien theory. And not to get too into it, but there are even hybrids of these types of things. But for the most part, your state is either going to be a title theory or a lien theory state. In a title theory state, the lender holds legal title. They actually have title to the property, and you as the borrower or the so-called homeowner have equitable title. Equitable title is basically possession. This kind of goes along the lines of, hey, I just pay the mortgage payment. I just live here. The bank really owns it. You know what I'm trying to say? Yeah, I kind of feel that way sometimes myself, especially in the couple of years right after 2008, when I had a bunch of equity, and then all of a sudden in the blink of an eye I didn't anymore. So the next one is lien theory, where the borrower has legal title and equitable title. In this case, the lender just has a lien against the property. Now, notice that in both cases, this is very important to notice that the homeowner has the equitable title. That of course means that the bank can't show up and have a barbecue in your backyard or sleep in your spare bedroom or use your kitchen because they don't have possession. You have possession, and this is a tricky question of actually who owns it. So under title theory, it's actually split, and under lien theory, it's all encompassing with the borrower, and that's very important. And then there's this other thing called deeds of trust. Let's draw a separate page to talk about deeds of trust. So with deeds of trust, it's a little bit different. There's not two parties, there's three parties involved. I think that's an important distinction here, as opposed to just the borrower and the lender. Under deeds of trust, you have the borrower and you have the lender, of course, and the lender is the beneficiary. I guess that would be the technical phrase for it. They hold the note. And should you not pay, then they're going to talk with the trustee to make sure that they can get a hold of the title, which the trustee is holding in trust. heaven forbid you don't make your monthly mortgage payment. So deeds of trust has got a three-party instrument, is the kind of the technical phrase for it, in which there are three parties involved, the borrower and the lender, of course, and then title itself is held by a third party called the trustee. Basically, it's held in, it's not a word I want to use. I'm going to use a word escrow, which I don't want to use. Basically, it's held in trust. Let's just leave it at that. It's held in trust until the mortgage is either defeated through the defeasance clause or accelerated, heaven forbid, through the acceleration clause. And then they get title from the trustee, and it goes back either to the lender or the borrower in full. Hopefully back to the borrower. We shouldn't go too much further, however, before we talk about some government loan programs. So the first government loan program that we want to touch base about is the FHA. And for you want to memorize the fact that the FHA insures the loan as compared to the other big federal government loan program, and there are many, but for today you really only need to know these two. The VA loan, the veterans loan, and they guarantee the loan, and the veterans loan is available for veterans based upon their time in the service. So the number of years they were in the service depends upon their eligibility for that. And the FHA loan is very helpful for those folks who want to put down a lower down payment or can't afford the conventional down payment and can't get PMI. So if you can't get PMI, you won't be able to get a conventional mortgage. And if you can't get PMI because you don't qualify for some reason, then you're going to go the FHA route. Both of these tend to be great loan programs. They're fairly, lenient in their qualifications. They're really good deals. If you qualify for the VA loan, it's a great deal. Take it if you at all can. It's a really good thing for the veteran. So keep in mind that the FHA insures the loan and the VA guarantees. That's going to be very, very important. The FHA loan started off this is a Depression era program from 1934, and I imagine the VA loan started somewhere in the 1940s, probably as a result of the Second World War or the GI Bill. I imagine it's a derivative of those. So very important programs. And now that we've kind of talked about all the different types of mortgages out there, it's now time to talk about the secondary mortgage market. Secondary, not third dairy, Jack. Come on now. Secondary mortgage market. Secondary mortgage market. And so this is a tough thing to explain. But remember when we talked earlier about the estoppel clause and how a bank looks at your loan as an asset? Well, back in the old-fashioned days, if this was you and you were borrowing money, you went, a little smiley face for you, you went up to your local bank. You went to the bank and you asked them for a loan. And they gave you a loan, because they knew you and you had a steady job like in the factory, back in decades ago, and the loan that they gave out, you paid back every month, and it was a nice little cycle in the community. Everybody knew everybody, and that's how it worked. Nowadays, that diagram is a little bit more complex, because nowadays you go get a loan at a bank or a lender, and then they effectively, to kind of make it a little bit, how should we say this, explain this, they basically sell it. They sell your loan and take it to an entity called Fannie Mae. Fannie Mae, that's probably an organization you've heard about before. And Fannie Mae takes your loan, we'll just represent it by this little rectangle here, and they're going to put it in a bundle of loans. So they're going to drop it in here into a bundle of loans. So there's a whole mess of loans in here. Here you go. Kind of better understand how this bundle works. There's a whole mess of loans in here. And there we go. So who buys these bundles of loans? There you go, like that. Who buys a bundle of loans? Well, financial institutions that have boatloads of assets or need to park assets and get a dependable long-term investment off of them. Oh, I don't know, like insurance companies or pension funds. So pension funds, for instance, they need to pay money out to their pensioners over time, slowly, and so they're looking for long-term steady investments. Typically, people pay their mortgage as a general rule of thumb, and the mortgage market's a good way to invest some pension funds. And you may even you'll be like, I don't buy mortgages in the secondary mortgage market. Well, if you have a 401k or an insurance policy or a pension or something like that, basically you are, chances are, through those institutions where you've invested. So not to kind of belabor this point, but in a bundle of mortgage, is if there's one bad apple in here, well, that's not a problem, is it? Because, well, it's bad for that person, but the system can kind of sustain that. And some of you may have seen the movie, what was it out recently? There's Margin Call, and then there's a new one out. Oh, God, it's at the tip of my tongue. I'm sure I'll remember it in a second. But basically what happens in these, leading up to 2008, is that there was more than just one bad mortgage in these bundles. There was a couple of bad mortgages in these bundles, and basically no one wanted to know what was in the bundle, because if you knew what was in the bundle, you wouldn't buy the bundle, and you certainly wouldn't you wouldn't want to sell it, you wouldn't want to buy it. So basically, there were some people that started to say, hey, you know those bundles you got? That default rate is going to start going way up when these extremely risky loans, there's some derivative of an ARM, started to become very, very risky, and the default rate is going to go way up. And there's a certain point where your bundle of loans, which you usually depend upon as a nice steady paycheck in order to pay off your pensions and whatnot, the values are going to go down. So what we're going to do is take a credit default swap. Basically, it's a bet against your bet, and therefore we're going to bet against you. And they went to Wall Street and they got people to take this bet. And eventually, unfortunately, and there's a scene in the movie where one person turns to the other and says, if we're right and this whole thing blows up, then tons of people are going to lose their jobs, lose their homes. So don't be so happy that this is going to happen. And eventually they were right, and few people made a boatload of money. But in the end, 2008 happened, and that was kind of stinky, I guess is the way to say it, because everyone's house value went down. A lot of people lost their homes, because effectively in that bundle there wasn't just a spare bad loan here or there. There were many loans, and the increasing number of bad loans, it just kept on going up. And eventually, if no one wants to buy this bundle, then Fannie Mae has to tighten down on the type of requirements that they're going to accept loans from your local bank. So you know how the phrase is, everything goes downhill, right? You know what I'm trying to say. So Fannie Mae talks to the banks and says, hey, we're only going to take loans to put in our bundles that are exceptional. So the bank hears that and says, well, we want to make sure that we can sell our loans to Fannie Mae. So then they go back to the public and say, hey, if you're not absolutely perfect, in other words, if you're somebody who doesn't need the loan, that's who we'll loan to. In other words, unless you're perfect with perfect credit scores and perfect payments and perfect tax returns and everything perfect, we're not going to give you the loan. And that's what happened in 2008 and 2009, and it's kind of loosened up a little bit since then, but basically the underwriting requirements got so strict that it was difficult to get a loan for your average person. So I'll put a little frown there on that person there, so that they couldn't get a loan loan because nobody wanted to take on the risk because we had a period of, as Alan Greenspan said, irrational exuberance. So in response to the crash of 2008, there was a new agency established by the federal government, the Consumer Financial Protection Bureau, the CFPB. This is the brainchild of somebody that you probably have heard of, Senator Elizabeth Warren. And basically, it's one thing that claimed to fame that helped her promote or propel herself to become a U.S. Senator. So this is a major law that revamped the way that we look at closings here in the United States. And in this particular case here, the CFPB now oversees a number of laws that are called, the new name of the new law is called TRID. TRID. In order to understand TRID, which is overseen again by the CFPB, in order to understand TRID, you kind of have to understand what existed before, because TRID itself is called Truth in Lending, RESPA, Integrated Disclosure. So as you can see, Truth in Lending and RESPA go right into the title, and so in order to understand TRID, you have to understand these other laws called Truth in Lending and RESPA. And by the way, we're also going to throw in the Equal Credit Opportunity Act while we're at it. That's also part of TRID too. So we'll just write that over here, Equal Credit Opportunity Act, and remind me to get to that one in a minute. So TRID, for the most part, is the consolidation of these previously two independent laws under one overall framework regulated by the CFPB. So first off, with Truth in Lending, the biggest regulation that we always know about here in Truth in Lending is the APR, the annualized percentage rate. The best way to think about that is like the mile per gallon sticker for your car. This is a way so that you can compare loan to loan, one loan to another, how much it's actually gonna cost you. Just like if you were looking at one Camry versus an Accord, which one gets better mile per gallon? It's the unit price sticker. Think about it that way at the grocery store as well. And so the most important thing that you should remember when it comes to Truth in Lending, which is occasionally called Regulation Z. Oh yeah, Regulation Z. Why don't we actually put that right up there when we have Truth in Lending? Truth in Lending is sometimes called Regulation Z, and it's overseen by Regulation Z in the same way. So let's actually spell that out. Truth in Lending, because that's what we're going to talk about now. You have to disclose the APR basically when any type of offer for financing includes some type of number in it. When there's a number in it, basically, you know, the percentage rate, how much money is going to have to be put down, the amount of the finance charge, anything like that. Whenever you see any type of number in there, even if it's written out like this format here, you still have to disclose the APR, which allows the consumer, again, to compare the product apples to apples with some other product, just the same way that a mile per gallon sticker would. So that's the APR. RESPA is the Real Estate Settlement Procedures Act. Real Estate Settlements Procedure Act. Sorry, I stumbled on that one. I don't know why. Real Estate, I'll write it over here for you. Settlement Procedures. Yeah, that's a long one, huh? Act. This is from 1974, by the way. So is, by the way, Equal Credit Opportunity Act, for that matter. That's 1974, too. Not 1947, Jack, 1974. So in RESPA, the big change in RESPA, there's a lot of different changes in RESPA, but the big change in RESPA nowadays, we used to have under the previous scheme. Oh, by the way, I can't believe I forgot to mention this to you. TRID went into effect in October 3rd, 2015. Went into effect October 3rd, 2015. So the big things that you need to know with RESPA, there's some vocabulary changed in terms of what we actually call the balance sheet. We used to call it the HUD or the HUD-1. Nowadays, it's just called the disclosure. And the important part of the disclosure is that it has to be distributed to the borrower 3 days in advance. Under the old scheme, prior to October 3rd, 2015, it was just 1 day. It was like the day before. You had to close on Friday at 9 a.m. You got your HUD-1 settlement statement, your final loan figures. You got it like Thursday at 3. It wasn't very consumer friendly, and the whole spirit of this law is to know before you owe. Know before you owe. So what the government is trying to do here, what the whole spirit of the law is that you go into this with your eyes wide open. You know exactly what you're getting into. It's kind of actually the opposite of what my father said, right? When he said, don't look at the paperwork, just sign for the house. Nowadays, the government wants to make sure that you have plenty of time to know exactly what you're getting into as part of it. One of the other important aspects of TRID is that they have to provide you with an estimate. It used to be called the good faith estimate. Now it's just called the loan estimate. I don't know if the vocabulary is that important to you, but basically they got to provide that to you within 3 business days of getting your application. So they got to give you a loan estimate within 3 days of applying, and they have to give you the final disclosure figures of what the actual numbers of the loan is 3 days before closing. And that's a big difference between because before it was just 1 day before closing, ditto. So that's a big difference. Nowadays, because of TRID and a couple of other things, but nowadays, most of our closings are, instead of 30 days, it's difficult to close in 30 days. Now, most of the time, we're looking for 45-day closing on a 45-day period. So, again, let me just summarize here. What we have here is the Consumer Financial Protection Bureau, CFPB, and they oversee TRID, which went into effect on October 3rd of 2015. TRID is basically 2 parts, and we're going to get to equal opportunity credit in a second. First, it's truth in lending, which requires the disclosure of an APR, especially when there's any type of offer made with a number. In RESPA, which requires a loan estimate within 3 days of applying and a disclosure of the exact cost of the loan within 3 days of closing. All right, let's get to that Equal Credit Opportunity Act in 1974. We'll go back to yellow for you. There we go. With this particular loan here, or act, I should say, this is very important to protect. Basically, reaffirms that you cannot discriminate based upon family status or marital status, and you must, I should probably just add that in marital over here, and you must issue a denial letter if you're not going to get the loan within 30 days. So this law here especially is targeted at gender discrimination for the most part, as it passed in 1974, which is kind of one of the periods of the Equal Rights Amendment at the women's rights effort in the early 1970s. And the whole spirit of this law, for the most part, it's supposed to protect everyone, of course, but for the most part is focused upon gender discrimination, family discrimination. You can't ask questions, for instance, hey, are you divorced? Are you widowed? You can't ask those types of questions. You can ask if you're married, but not necessarily those types of questions. You can't ask if you're going to have more children, that type of thing. Totally illegal. You can't do that under what we call the Equal Credit Opportunity Act, the Equal Credit Opportunity Act. So very, very important. I think for the most part, we've kind of gotten used to in our business now. It's been over a year since TRID came along. Most of us have gotten used to dealing with TRID. And for most of your offers, you're going to want to factor in a 45-day closing instead of a 30-day closing. I will say this, just something to think about in terms of TRID. In these regards, for the most part, the legal community has not yet come to grips with what happens should, for instance, these 3 days over here, the lender doesn't provide the notice within 3 days, and then you can't close under TRID, and so the closing is delayed a day or 3 or 4 or 5 days. What happens then? So the legal community really hasn't addressed this issue. They will get around to it, but nowadays most attorneys have their own what they call TRID rider, which goes in addition to the standard P&S and is tacked on to the standard in P&S. And until the legal community kind of comes to terms with how they want to address the liability should the lender not perform relative to the TRID guidelines. Is that going to be a fault of the buyer? Is that going to be a fault of the seller? No one at fault? How is that going to play out? So nowadays, most lawyers have their own TRID rider, which of course each lawyer thinks theirs is the best. And the lawyers, you're going to see more and more lawyers involved in real estate transactions, even the most rudimentary transactions, which years ago would not involve an attorney representing a buyer and a seller, usually just the attorney representing the lender. Nowadays, you have more and more attorneys involved in the process, mostly because of TRID. So let's shift gears and talk about our final segment for the financing chapter, and that's about predatory lending and usury laws in terms of fraudulent loan practices. Okay, so 3 kind of no-nos, we'll call them no-nos, you can't do these, in the mortgage business. First off, mortgage fraud. And mortgage fraud can often involve kind of a conspiracy here, sometimes between the seller, the loan originator, and the appraiser. If they all get together and put a price tag on the asset, therefore they might be able to kind of rig things up so that they can have a conspiracy. There you go. Sorry about that. So that they can have a conspiracy to defraud either the lender, who in the big corporation, or the buyer. So mortgage fraud is very, very sophisticated, but nonetheless, you cannot commit mortgage fraud. When you apply for a mortgage, for instance, and they ask you who you are and what your name is, and if you are actually the real borrower, or is there somebody else the real borrower, straw borrower, that type of thing, that's all mortgage fraud. Of course, I know none of you are ever going to do that, and I can't even come up with an example of that because I don't have the master criminal mind to actually figure that out, but it does exist. Okay. Predatory lending, that's a fairly common phrase that we hear nowadays because it is the exact opposite of what we talked about earlier with the know before you owe law. So this is the opposite of know before you owe. And if you're out there as a financial institution offering loans and you're not providing with the proper disclosures and that type of thing, and you're not complying with know before you owe, then you could be very easily accused of predatory lending and keeping people in the dark about what loan they're actually signing up for. And the last one is the usury law. This is fairly straightforward. Obviously, the law does cap the interest rate that people can pay. This could be variable in different states, however. And needless to say, you can only charge so much in interest. And to charge too much is called usury. Charging in excess in excess of the legal limit. In excess of the legal limit. That's a no-no. Can't do that either. So these are the kind of big no-nos in the mortgage business. You can't conspire amongst buyers, sellers, mortgagers, mortgage officers, appraisers, that type of thing. You can't predatory lend. If you are a lender, you can't keep people in the dark or switch paperwork or be deceitful in that way, unfair in that way, abuse people that should have the benefit of counsel, for instance. And usury laws. You can't exceed the legal limit. So that has been financing. This is lesson number 6, I believe, if I haven't lost track of it. And thank you for joining us. And let's get back to the live portion of the webinar. Remember, of course, that I'm always here. My name is Jack Gately. I'm always here, even while you're watching the videos. Either me as your instructor or another licensed instructor, but mostly me. I'm here in the background here, so just raise your hand with the webinar software. Happy to answer any question you have. Thanks for joining us.